Oh, hi, it's Susie again from Esoteric Trading Solutions. Just want to go over the US equity market. Question is it in a bubble, or are the US equity markets in a bubble very quickly? Don't want to waste too much of your time. Head of Dutch Central Bank, Klaus Knot, yesterday basically, and he's very well known also because he also sits on the European Central Bank Commission as well, basically said that the picture resembles the financial markets, and the equity market particularly resembles the period before the financial crisis of 2008. And he said we're about to witness a brutal collapse in asset prices. He didn't say specifically which financial markets, but I assume he's talking about equity markets and credit markets, and also volatility is all-time lows. When you look at the S&P volatility index, and the volatility index is on a lot of stocks, and the volatility index on foreign exchange, everything's pretty low, and credit spreads are really low as well. Previous to 2008, 2007, credit spreads were way in as well, and things were at highs then. So I sort of agree with him, actually. He talks about overvaluation, low levels of volatility and risk, and the market's not pricing in that risk. And he says there's a risk if the US starts raising rates aggressively, then the market pretty much has a risk of coming off quite quickly. So I tend to agree with what he's saying there. And also Wolfgang Schäuble, the German finance minister, also says the same thing. So 2008's a while ago, and obviously the US market's a lot higher than that. And you've got to really say, wow, this is it's a bit scary, because the US equity market is a lot higher. Australian market is nowhere near the highs of 2007, early 2008. Our our PE is still around 15 to 16, where the US is around 23, and long-term average for the US has been anything between 15 to about 17. So if you look at the S&P, again, as I said, it's around 23. When we go back to 2008, it was probably, and if you look at the red, that's the S&P PE, the price earnings ratio. The red in 2010 was about 23. It's back there now. But if you go back to 2008, that PE was actually lower. So PE was around 15, 16 when it came right off down to 10, where you can see me pointing, and then went up to about 23, and that's pretty much where we are now, 23, 24. So it is pretty high. So long-term averages are below 20, obviously, and we're sitting at 23. If you look at the US technically, there doesn't seem to be any reason to sell that market. It looks very good technically, but the reality is the technical picture can change very quickly. If you have a look at that, the Dow just keeps going and going. But mind you, if we look back in 2008, the Dow, when it came off its lows, was 6,700. Now it's back to 22,830. So it's pretty much gone from here all the way up there, which is a pretty amazing move. And as I said, the Australian market hasn't done that at all. Going back, so really when we look at is it a bubble, the things I look at are interest rates. Interest rates are very, very low. They've been negative, and particularly negative in the long end of the curve as well as the short. But the long end of the curve runs the risk of, prices going down and interest rates moving up quite quickly. So it's a rate of change that's actually moving up quickly. And when we talk about equities are perpetuities, cash flow perpetuities, and those things basically, equities get valued off interest rates. So, really, if interest rates go up, the denominator is higher than the price, then equity price should be lower. So in other words, if interest rates are lower, then the denominator is lower, the price would go up. But as interest rates rise, the denominator becomes higher and the price actually comes down. Credit spreads are extremely tight at the moment. So again, I see that as a huge risk. And that's what happened in 2007. Credit spreads were very, very tight, and all of a sudden credit spreads in the bond market started blowing out. And that was a real thing for me, because I actually noticed that when I was working as a stockbroker, and credit spreads were blowing out dramatically. The US market, in my mind, is definitely overpriced, and I think that's a real risk. Economic growth has been middling, particularly in the US, so again, neutral. But look, the Fed can come out and basically, have a very aggressive tone in terms of interest rates, and that could be a real test. The analysts, again, are all bullish, and I do think that's a risk because analysts always seem to be bullish. Banks, I've noticed here particularly, I don't know about overseas, but banks here particularly, because of all the bail and all the restrictions on what they can do and what they can't do, and they have to come up with capital to make sure their balance sheets are fortified. If there's another market sell-off since 2008, they are definitely tightening up on their funding and their credit risk. They're not lending out so much to housing. They're being really, really strict on who they can actually lend to. So that means that not so much money is going into the market, so liquidity is becoming a problem. The liquidity is not there like it was pre-2008, and I think that could be a problem in itself, particularly in bond markets that and currency markets that used to fund the equity market. What we saw in 2008 when markets start selling off, liquidity is nowhere to be seen. So in other words, I was around 2007, 2008. I was also around 87, and I remember you couldn't get liquidity anywhere. So in other words, you couldn't get money. And to try and borrow money, interest rates just went through the roof. Particularly in 87, interest rates went through to 17, 20%. There was no liquidity on the day of the stock market crash. And the same thing happened in 2008 and 2009. Banks would not, big major banks, say for example ANZ, Westpac, NAB, would not lend out to all the regional banks here. So banks like Suncorp, Metway, Bank of Queensland, there was a real risk they were going to go down, and that would have caused a domino effect in the financial markets. The banks had to be bailed out, and that's pretty much what happened overseas as well. I think that is a real risk. Also, central banks are selling down all their assets. US Fed has actually announced that, and they've got sort of 4 to 5 billion or 6 billion of assets they need to sell. And when they sell those assets down, they actually take liquidity or money out of the market, and that in itself is a problem because that's money they're physically taking out of the market where they sell something. Someone's got to buy it, and they're giving their money. That counterparty is giving the Fed money. Banks in Greece, Italy, Portugal and Spain are still not very healthy. They have very, very bad loans, and the reality is things in those countries look terrible. Now, the Italian equity market is still at all-time highs, and Italy has got terrible problems. I think Italy is the next Greece. That's my personal opinion, because their accounting systems are old. No one really knows what's going on. There's been bad lending practices, and Italy, again, I really believe has a lot of debt. They're probably the third or fourth largest bond market in the world, and they do have a lot of debt. So I think Italy could be the one to look at it. Also, I read something ages ago that the IMF, the International Monetary Fund, and the European Central Bank aren't going to fund in Italy by the end of the year. And Italy is effectively broke. So if they don't get money from somewhere, that could be the next Greece, as far as I'm concerned. Again, going back to selling about of assets, taking money out of the system, that's correct. And there could be a catalyst for this. North Korea, no one's really taking any notice of North Korea and what Trump's saying. And like every equity market sell-off, there always has to be a catalyst. Markets go up by the what's the old saying? They go up by the steps and they come down by the elevator. Also everyone is long in the equity market. That's just what I can see. Margin lending is all-time highs here particularly, and I imagine overseas it's the same. Corporate profits are up on cost reductions. Market is very, very complacent. S&P volatility is at all-time lows, around 10.8. If you look at volatility on other markets, say FX options and credit options and swaptions and all sorts of other things, volatility is low again. So yes, the risk is high. S&P volatility, as I said, is around 10. Go back to go back to 2008 before the crash. Equity volatilities were probably around, what are we looking at? Probably around 17, and they got up to well over 50. Now we're looking at 10 here, which is just way, way too low. I mean, what happens when you get to zero? You start going negative. So the Dow, again, doesn't look like it's going to sell off. Technically looks good, but as I said, the technical picture can change very, very quickly. If we look at that, if we want to take advantage of this, probably the best thing to do is look at the components in the Dow. Dow has 30 stocks, and the one that I don't like at the moment is Apple. Apple's up 35% this year, but I do think Apple looks technically quite negative. It looks like it's getting tired to me. China doesn't like the new iPhone 8.
I think Apple's got a real problem at the moment regenerating the revenue that it has in the past, because honestly, it just keeps bringing out these iPhones. The Apple Watch didn't work. It keeps bringing out iPhone series after series. And seriously, people don't have $1,500 or $1,600 to buy a new phone. So if I was going to pick anything in the Dow, I'd be looking probably at Apple, and I'd be buying long-dated puts. In other words, I'd be buying the option to sell at the market, the Dow, or to sell Apple stock at a certain level in the future. And long dated puts look fairly cheap to me at the moment because volatility is still fairly low, even though Apple's volatility has been rising in the last year. Evidence does suggest that when you buy a long dated put in the market, when markets come down very quickly, the long volatility spikes up quite dramatically, like massively, and it over spikes up quite dramatically. So I think it's probably not a bad play to buy long dated put options on Apple, which means you're going to buy an option to sell Apple at a certain price. So if the price goes lower in the short term or over the time of that option, you should make money, providing time doesn't erode too quickly. So I'd be looking at that. Apple volatility is on the rise, as I said. If you look at the chart going back for, say, 1 year through to now, volatility was around 21%, got up to about 26%, then obviously came down, down to zero nearly, and back up, and now it's back up on the rise again. So I would definitely be looking. I know, the last 12 months it is probably a bit more expensive than it has been, but that is actually telling you something. That's historical 30-day implied realized stock volatility, and it looks like it's heading towards 25% if you just have a look at that. So looking at long-dated volatility for Apple, on the right-hand side here, if you bought something at the money, Apple stock is around 155 at the moment, 155. You bought something at the money, 155, looking at a put with an expiration, 21st September 2008, which gives you plenty of time, by the way. You'd be paying, let's have a look here, you'd be paying something like, so pretty much the volatility, as I said, is 26%, and the volatility is 155. So let's have a look at the bid offer here. Bid offer is around 24 to 14. Bid offer spread's quite wide, but I guess when you go long to dated, you can't really help that. That's all there is to it. Sorry, that's the strike on that side. My apologies. So if you look at the strike here, say 155, which is at the money. Bid offer is 24.14. Just make sure we've got the right thing here. Looks a bit weird how it's printed out on that. Bear with me for a minute. That's the delta. Oh, okay, I see what you mean. Right, it's sort of moved across, which is unfortunate. That's the delta. Their volume is that. Bid on the volatility, bid ask and volatility. Okay, that makes sense. Sorry, I'm just trying to work out how it's showing this. So the bid offer is that, and that's the bid and offer on the volatility, because you can buy and sell volatility as well. So my apologies, I'm just trying to work this out because, okay, so effectively you've got the delta, which is this, you've got the volume, which is this, you've got the bid on volatility, intrinsic volatility, which is the green, you've got the offer on intrinsic volatility, which is that, and you've got the bid and offer to buy the option. So we'd be looking at this column and this column. So pretty much if I was going to buy a 155 option, a put option on Apple, I would be paying 14.5 for a 155 put option on Apple, and the volatility level at the moment is 24%, which is about right. Okay, so that's what it would cost me. Now, if Apple starts to sell down, that's good for us. It means that price will go up. So that's a long-dated option, and that long-dated option's got an expiry of 21st September 2018. So I think buying a few of those would be nice thing just to hold on to. You've got plenty of time expiry on those, and let's see what happens. Cheers. Thank you for listening. Bye for now.